of Accounts. Today in this class let us discuss how to write journal entries. How to write journal entries. Let's see. It is very simple, easy to understand. To write journal entries, first of all we should be perfect with the rules of the debited credit. So as you know very well, in our last class I have explained you the accounts are classified into three: personal account, real account and nominal account. So these are the rules of personal account, real account and nominal account. So based upon these rules, now we are going to write the entries. So these journal entries, these entries will be written in the first book called as a journal. So journal will be of this particular type here. So in the journal, normally we will be having 5 columns: date column, particulars, LF, amount and amount. This is debit amount, this is credit amount. So LF means ledger folio. Okay, there is nothing but page number in the ledger. Now let's see how to write the entries. See, whenever we are writing the dates here in the date column, okay, whenever we write in journal or in the ledger, first of all we should write the year. So our year here is 2015. I have written the problem here for your particular pursuit. So you can go through the problem here. What is said? Generalize the following transactions. So the year is 2015. So we are writing 2015. Okay. Then again we should write the month. So January. So first transaction is on the date on first date. So number 1. In other words, the date for date. So year, month, date. This is how we are going to write the in the date column. So let's see the first transaction, how to write the entry. See, first transaction what it says, Ram commenced business with rupees 5 lakhs. That means here Ram, okay, he has started the business by bringing 5 lakh rupees into the business there. So Ram is the proprietor. He is the person who is going to commence the business. So whatever proprietor brings into the business to commence the business, we will call it as a capital. So what he has bought? Cash he has bought it. So now here when we are writing in the books of accounts, think from business point of view, cash came in. So the accounts which are affected, okay, normally we will view the journal entry in this particular manner. By seeing each transaction, 2 accounts will get affected. So what are those 2 accounts? One, the cash is coming into the business. So one is cash account which will be affected. Another one, whatever the proprietor has bought into the business to commence the business, will call it as capital. So another account affected here is capital account. Okay. So these accounts, this particular thing, whatever is taking place here, okay, this should take place in your mind while writing the entries. So these are the 2 accounts which are affected by this particular transaction. Ram commences the business with the 5 lakh rupees means here. One is cash is coming into the business. Another one is whatever proprietor has bought into the business to commence the business, we will call it as capital. Now see, this cash account, now you identify which account it is. Cash account, is it personal, real or nominal? See, cash being an asset, okay. So which account it is? It is a real account. Okay. When we have identified it as a real account, see the rule of real account. What is the rule of real account? Debit what comes in, credit what goes out. That means here in this transaction, if cash is coming into the business, you debit it. If cash is going out, you credit it. So in this transaction, what is happening? Cash is coming into the business. So this particular cash account we are going to debit it here. Now coming to the capital account here, see, capital account is nothing but it is representing the proprietor who is a person. So this is a personal account. So when it is a personal account, refer to the personal account rule, debit the receiver, credit the giver. That means if this person in this transaction, if he is receiving, debiting; if he is giving, you are going to credit it. So what happened in this transaction? When Ram has commenced the business there, he is giving this much capital to the business there. So credit the giver. So simply here we are going to credit capital account. So cash account we are going to debit, capital account we are going to credit. So our entry will be something like this. Cash account debtor. This is the way of writing an entry. Cash account debtor to capital account. Okay. See how much the amount is 5 lakhs. So 5 lakhs you are going to debit against the debit amount, and against the credit account you are going to credit 5 lakhs there. Okay. Next here we are going to write what has happened in this transaction there, which is called as a derivation. So there is nothing but being business commenced. Okay. See, narration you can write in your own words, but the way of writing an entry is the account which we are debiting, first we are going to write it, then the account which we are crediting, we are going to write it by writing it as by prefixing it with the 2 T. T should be capital. So here this particular one should start as if it is touching this particular line, whereas here we should leave out some space there, and this particular D should be a capital letter when you are writing an entry. So this is the first entry. Now coming to the next one. Now next one you see, next transaction you can see purchase deposited into bank on which date? On January 2nd. So January 2nd. Okay, deposit into bank. What will be deposited into the bank? Cash will be deposited into the bank. In other words, cash from our business will be deposited into bank. So the two accounts affected are, one is cash account, another one here is bank account. Okay. Now when we identify these two accounts which are affected by this transaction, now once again you check it which account is cash account. Cash account being an asset, it is a real account. Cash is our asset there, so it is a real account. When it is a real account, the rule of real account says debit what comes in, credit what goes out. In this transaction, when the cash is deposited to the bank, cash is going out. So we should credit what goes out. So cash account we are going to create it. Now bank accounts, check it. Bank account is the name of one particular bank. Bank is an institution, so it is a personal account. When it is a personal account, okay, when it is a personal account, the rule of personal account what it says, debit the receiver, credit the giver. In this transaction, when cash is deposited to the bank, banker is receiving. So we should debit bank account. So our entry should be, the account which we are debiting should be debited first there. So bank account data to cash account, there is our entry. Bank account data to cash account, being cash deposited. Okay, this is what we are going to write it in the narration. How much amount? The amount is 30,000. So 30,000 you write down like this, 30,000. Next you check it. Next transaction. 7th date, if you observe 7th date transaction, if you check it, how it is. See, after second we are having 5th there. So let's take 5th date. So on 5th, purchased goods from Tarun. Okay, what is purchased? Goods are purchased. So I have already told you, whenever goods are purchased, purchase account should be debited. Okay, in other words, purchase account will be affected there when goods are purchased. So one is purchase account. Another account which is affected by this transaction is purchased goods from Tarun. When he said, what type of transaction is it? Is it a cash transaction or a credit transaction? Have you purchased by paying cash immediately, or you have promised to pay it in the future? Means if you go through the transaction, what he says, purchase goods from Tarun, when he said, it means that you have purchased on a credit from Tarun. Okay, if you have purchased on cash there, at that time he would have said purchased goods, or he would have said purchased goods from Tarun on cash. So here simply what he said, purchased goods from Tarun, when he said, it means you have purchased on credit. Okay, in other words, you have not paid the cash immediately. So at that time, that particular Tarun's account will get affected. So the accounts affected are, one is purchase account, another one is Tarun account. Okay, now check it. Purchase account, which account it is? Purchase being an expense to you. Okay, it is an expense there. It is a nominal account. So according to nominal account, what does the rule now? What does the rule say for nominal account? For nominal account, the rule here is debit all expenses and losses. Okay, these purchases are expenses to us. So what we should do? We should debit purchase account. Next Tarun account. Tarun is a name of a person. So it is a personal account. Okay, personal account rule, what it says, debit the receiver, credit the giver. Now when you have purchased from Tarun there, okay, Tarun is giving to you, so we should credit the giver, we should create him. So our entry will be purchase account data to Tarun. Okay, purchases account data to Tarun account, being credit purchases, being credit purchases. This is the transaction. So the amount here is how much? Amount is 10,000. So 10,000 you are going to write it like this. Okay, then again next transaction. See what I am doing it here, it should take place in your mind. You should think of and you should start writing it there. This is because this is the initial class, I am explaining you right by writing here on the board there. See, observe here, next 7th day transaction, sold goods to Parole. Okay, who has sold? Your business has sold goods to Parole. You have sold goods. When you have sold goods, the account affected here will be the sales account. Okay, when you have purchased the goods, purchase account will be affected. When you have sold the goods, the sales account will be affected. And again you see, sold goods to Parole, when he says you have sold goods to Parole on cash or on credit. Okay, check it out. If you have sold on cash there, okay, simply he would have said cash sales or simply sales. Okay, or he would have said sold goods to Parole on cash. But here what he said, sold goods to Parole, when he said, it means you have sold it on credit. That means Parole has purchased from you on credit there. So here at that time this personal account, in other words, your account on the name of Parole will get affected here. So these are the two accounts. One is sales account and other one is Parole account. So sales account, here what is the sale? Sales account, what is it to you? Purchases are expenses to you. Okay, sales are incomes to you. Okay, when they are income, okay, sales is nothing but it is an income. Okay, when it is an income, incomes comes under which account? They are nominal account. Okay, so sales account is a nominal account. When it is a nominal account, the rule of nominal account, what it says? Debit all expenses and losses, credit all incomes and gains. Sales being an income to you, sales account should be created here. Okay, then Parole, you see, Parole is the name of a party, person, so it is a personal account. When it is a personal account, the rule of personal account, what it says? Debit the receiver, credit the giver. So Parole, in this transaction, when goods are sold to Parole, okay, debit the receiver, credit the giver. Okay, in this transaction, when you have sold goods to Parole there, what is Parole doing? Parole is receiving from you. Okay, so you are going to debit Parole's account. Check it. Your entry should be the account which you are debiting. First, you should write that one. So Parole account data are to sales account. That is your transaction. That is your entry. Parole account data are to sales account. Being credit sales. This is your entry. This is for the dated 7th. Next, 8th date, you see on 8th date what happened. Purchased machinery. Okay. When you have purchased machinery, what are the accounts affected here? When you have purchased machinery, when machinery you have purchased it. Okay. What you have purchased, you have not purchased the good there, but you have purchased machinery. Machinery is an asset. So at that time your purchase account will not get affected. The accounts affected are, one will be machinery account. Okay, because it is an asset here, it is a machinery account which is coming into your business. Okay, one is machinery account. Another one, what he said, purchased machinery. When he said, it means you have purchased machinery. How you have purchased? By paying cash immediately, or you have purchased on credit. You should put a question to your mind here. So what he says, purchased machinery, when he said, he has not named the name of the party there, it means you have purchased it by paying money immediately. Okay, how you have paid? You might have paid by way of cash there. Okay, so at that time, these are the two accounts which get affected by this transaction. One is machinery account and another one is cash account. Now check it out. Machinery account is nothing but here. Machinery is your asset. When it is an asset, it is a real account. Since it is a real account, okay, what the real account says, debit what comes in. So in this transaction, when you have purchased machinery, machinery is coming into your business. So machinery account, you are going to debit it. Now cash account, check it. What is cash account? Cash account, once again, it is your asset only. So once again, it is a real account. So when it is a real account, once again the same rule, debit what comes in, credit what goes out. In this transaction, when you have purchased machinery, cash is going out. So since it is going out, you should credit this account. Okay, check it. Machinery account you are going to debit, cash account you are going to credit in your entry. So your entry should be machinery account data are to cash account. Okay, machinery account data are to cash account. Being purchase of machinery. You have purchased machinery for how much? For 20,000. See, for this transaction I have not written the amount there. The amount is 5,000. Okay, please do correct it. This is 5,000. The amount I have not written earlier. Okay, so this is how we are going to write the entries there. Now for the next transaction, let's see. Next transaction is for 10th one. Okay, on 10th date. So I am rubbing up to this one. See, after 8th we are having a 10th date. So on January 10th, what happens here on January 10th? Purchased furniture. What you have purchased? You have purchased furniture from Ajay for 10,000 rupees. So when he said purchased furniture from Ajay for 10,000, it means you have purchased furniture from Ajay. Okay. And how you have purchased it? Have you paid cash immediately? You have not paid it. Since what? Because he said purchase furniture from Ajay. It is a credit purchase. Okay, what you have purchased? Furniture. Furniture is not your good. So here purchase account will not come. Which account will be affected here? One is your furniture account, because when asset is purchased, asset account should get affected. When asset is sold, asset account should be affected there. So here you have purchased furniture. So one account affected will be furniture account. Another one, how you have purchased it? You have purchased it on credit. That means immediately cash you have not paid. So at that time the party's account will get affected. From whom you have purchased? From Ajay you have purchased. Check it. Furniture being an asset, it is a real account. Since it is a real account, what does the rule of real account says? Debit what comes in, credit what goes out. When you have purchased furniture, furniture is coming into your business. So furniture account you are going to debit it. Then Ajay. Ajay is a name of a party person. So it is a personal account. Debit the receiver, credit the giver. In this transaction, when you have purchased from Ajay there, at that time Ajay is the giver. He is giving the furniture to you. So his account will be created. So your entry will be furniture account data R2 Ajay. So your entry should be furniture account data R2. Furniture account data R2 Ajay account. Being purchase of furniture. See, it is understood by the transaction that it is a credit purchase there, because the name of the party we have written. So purchase furniture from Ajay for how much? For 10,000. So 10,000 you are going to debit, 10,000 you are going to credit it here. Okay. Next, on 17th date you see, 17th. What happened? On 17th, issued check to Ashok. Okay. You have issued one check to Ashok there. Observe. Issued check to Ashok. That means you have written one check on the name of Ashok and you have given to him. So when you have issued check to Ashok there, what are the parties affected here? Clearly understand here. When you have issued the check to Ashok, you will be giving that particular check to Ashok because you are supposed to give to him. So one account affected will be Ashok's account. Okay. Then again, when you have issued the check there, that check Ashok will take it to the bank and he will draw the money from your account there. So your bank account will get affected. So another account will be your bank account. These are the two accounts which are affected. Check it. Ashok, it is the name of a person there. So it is a personal account. Ashok account is a personal account. Since it is a personal account, the rule of personal account says debit the receiver, credit the giver. In this transaction, when you have issued check to Ashok, Ashok is receiving. So debit Ashok account. Then bank account. Bank account, once again you can say personal account. Okay, personal account rule, once again you see debit the receiver, credit the giver. Banker is giving the money. Okay, on that check there. So this account we are going to create it. So our entry will be Ashok account data R2. Ashok account data R2. Bank account we will write. Being check issued. 5,000 rupees. So 5,000 we are going to write it here, the amount column. Then next you see, next what happens here. See after that, withdrawn cash for office use. That means, or you can say drawn cash from bank for office use. Okay, in other words, here from the bank we have drawn the money for what purpose? For office purpose. Check it out literally what is happening. Money is drawn from the bank and it is coming into your particular office. When it comes into your office, there for office purpose, when you have drawn it, that amount will be added to your particular cash in the business. So the accounts affected are, one is cash account, another one here is the money is going away out of your bank account. So another account affected will be bank account. Okay, so when withdrawn cash for office use, that means you will be drawing it from the bank only. So one account affected is cash account, another one is the bank account. Once again you check it, cash account being an cash account is a cash is an asset to you. So cash account is a real account. Since it is an asset account, it is a real account. Debit what comes in, credit what goes out. When you have withdrawn cash from the office, cash for office use from the bank, cash is coming into the business. So cash account you are going to debit it here. Whereas bank is a personal account, because bank is an institution, it is a personal account. Debit the receiver, credit the giver. in this transaction when cash is withdrawn from the bank there, banker is giver. So we are going to credit bank account. So our entry will be cash account data to bank account. Cash account data to bank account being cash drawn for office use here. So this is for 18. The amount is 5,000. Next, on 20th date, you see what happened on 20th. On 20th, drawn cash from bank for personal use, he says. Okay, drawn cash from bank for personal use. That means who will draw for personal use? The proprietor will draw the money for personal use here. Where from he has drawn? From the bank account of the business there. Okay, so whenever a proprietor has drawn any particular, in other words, if the proprietor has used any particular cash or any particular asset or any particular good for personal use, then the account affected will be, one is drawings account. Okay, so what are drawings? Money or money is worth withdrawn by the proprietor for personal use. They are called as drawings. So here money is drawn from the bank for personal use. So one account affected will be drawings account. Another account affected will be this money is drawn from the bank there. So bank account will get affected. Okay. So check it out here. Drawn cash from bank for office use. See, drawings account, which account it is? Drawings account, it is representing the proprietor. Okay, proprietor is a person. Okay, so it is a personal account. So simply remember, capital account is a personal account. Drawings account is also a personal account. So drawings account, it is a personal account. So when it is a personal account here, the rule of personal account says debit the receiver, credit the giver. In this transaction, when money is drawn from bank for personal use, proprietor, okay, he is receiving. In other words, drawings account has to be debited because drawings account is representing the proprietor here. So drawing should be debited. Whereas the bank account, if you observe, bank account once again it is a personal account only because every bank will have one particular name. It is an institution. It is a personal account. So debit the receiver, credit the giver. That is the rule. Okay, credit the giver. So banker is giving. So bank account you are going to credit it. So how you are going to write it? Draw debit whatever is the account you are debiting, that you are going to write first in your entry. So your entry will be drawings account debtor to bank account. Being cash drawn for personal use. So how much amount? 1,000. Next, see next transaction if you check it. Next transaction is sold goods to X on credit. Okay, sold goods to X on cash. Sorry, on cash he said. That means you have sold goods to X on cash. Now check it from business point of view. You should think of when you have sold goods to X on cash, what is literally happening? From your business, goods are going out. Okay, what you have done? You have sold the goods. When you have sold the goods, one account affected will be your sales account. Already have told you, if you have purchased the goods, purchase account will get affected. If you have sold the goods, sales account should get affected. So you have sold goods to X on cash means here one is sales account. Now how you have sold to X? You have sold to X on cash. That means immediately you have received cash from X. So when you have received from X cash immediately, it means here which transaction it is, credit transaction or cash transaction. Which type of sale it is, cash sale or credit sale, means it is a cash sale. Immediately you have received the cash. So another account affected will be cash account. Here X account will not come. Okay, if you have sold goods to X on credit, at that time X account would have been affected here. But you have sold on cash there, so immediately cash is coming in. So when cash comes in a particular transaction, okay, in case of a sale there, the transaction will come to an end there itself. So there is no further continuation. So the name of the party will not come here. So X account will not come. So the accounts affected are, one is sales account, another one is cash account. So sales account being which account it is, already I have told you. Sales are nothing but here they are incomes to you. Okay, sales are income because sale of goods is represented by sales account. It is an income. Since it is an income, Okay, which account it is? It is a nominal account. So according to nominal account, credit all incomes and gains. So since it is an income, we should credit sales account. Now check it. Cash. Cash is once again your asset there. Okay, since it is an asset, it is a real account. Real account rule, what it says, debit what comes in, credit what goes out. So in this case here, when you have sold goods takes on cash, what is happening? Cash is coming into your business. Debit what comes in. So this account you are going to debit it. So your entry will be first whichever account you are debiting, that you are going to write in your entry. So your entry will be cash account debtor to. Cash account debtor to sales account being cash sales. Okay, so this is on 21st date. So the amount will be 800. Okay, so this is the one problem I have told you. Like this, if we take up the problems for every transaction, okay, first of all you imagine what are the accounts affected. After imagining the accounts there, check it out to which particular category it belongs to, whether to personal, real or nominal. Based upon that, apply the rule, then you will be knowing what to do. Should we debit it or should we create? Well, now let's see our second problem. See, problem I have written here for your personal and the answer I have given here. So let's discuss regarding this particular one. So here is also generalize the following only. So the year is 2020, February 1. So 2020, February 1st there. Okay. So this is February 1st. See what is said. Commence a business with rupees 8 lakhs. So when the business is commenced, normally the accounts affected are, one is cash account, another one is capital account. As you are aware, in the morning also I have told you, in the earlier class, in the earlier form I have told you. So cash there, the real account is an asset, the real account, debit what comes in. So since it is the real account rule is debit what comes in. When cash is coming in, we are going to debit this one. Whereas capital is nothing but it is representing the proprietor. So proprietor is a person, so it is a personal account. So debit the personal account rule is debit the receiver, credit the giver. Proprietor is giving, so we are going to credit capital account. So our entry will be cash account data to capital. This is the entry. Next, see cash account data to capital being the business commenced. Amount is 8 lakhs. Next, received interest from Krishna. Observe this, when received interest from Krishna, you have received what? You have received interest. Okay, interest you receive in terms of cash. So the accounts affected are, one is cash account, another one is, since you have received interest is the income which you have earned, so the account affected will be the interest account. Okay, here Krishna account will not come because you have received interest. So when you have received interest is a revenue to the business, that is an income. Since it is an income, interest is a nominal account. So when it is a nominal account, the rule of nominal account, what it says, debit all expenses and losses, credit all incomes and gains. Since it is an income, we are going to credit this particular account. Whereas cash account, if you observe, as already we have discussed many times, cash is nothing but our asset only. So since it is an asset, it is a real account. So real account rule, what it says, debit what comes in, credit what goes out. When cash is coming in, we should debit it. When cash is going out, we should credit it. So here in this case, when you have received interest from Krishna, cash is coming in. So debit what comes in. So the rule is debit what comes in. So cash is coming in. So cash account you are going to debit. So your entry will be cash account data to interest account. See, cash account data to interest account. This is the entry. Date you have written, amount you have written. Narration is being interest received. Okay. Now see, on 5th, goods withdrawn for personal use. See, on 5th, when goods are withdrawn for personal use, who has withdrawn? Proprietor has withdrawn for personal use. So when proprietor has withdrawn any particular money or money's worth from the business for personal use, then the account affected one here is the drawings account. And what he has withdrawn? He has withdrawn for personal use what? Goods. See, goods in the business will be there in purchases account. When you have purchased the goods, purchase account is debited. Already I have told you. So the other account affected here is purchases account. Okay. Now observe this particular one, drawings. Which account is drawings account? Personal, real or nominal? Means drawings are representing the proprietor who has drawn the money. Proprietor is a person. So drawings account is a personal account. According to personal account, debit the receiver, credit the giver. In this case, proprietor is receiving. So debit the drawings account. Then purchases, if you observe, purchase already have told you, it is nothing but an expense there. But here in this case, goods are going out. So we are going to treat it as an income here. So nominal account we are going to create it here. So observe this one, drawings account data to purchase. Purchase account will be created only in this case when goods are going out of the business. Purchase account will be credited. Okay, so here your entry is drawings account data to purchase. That is the entry. Amount is 2000, being the goods withdrawn. Okay, even if you can write for personal purpose or personal use also. Okay, next further. See, paid rent to landlord. What you have paid? You have paid rent. Okay, so think from your business point of view. What is rent to you? Rent is an expense there. Okay, so one account effect here is rent account. Another one, rent, how you will pay? You will pay in terms of cash. Cash is going out of your concern. So other account effect here is cash account. Okay, here landlord account will not come because you have paid rent there, which is an expense to you. So that expense account will be affected. Another one you have paid through cash, so cash account will be affected. Observe, rent account is a expense to you. Since it is an expense, it is a nominal account. According to nominal account rule, debit all expenses and losses. So rent being an expense, here you are going to debit rent account. Then cash account is nothing but is an asset, as you are aware. Cash is an asset, so as such it is a real account. So debit what comes in, credit what goes out. In this transaction, when you have paid rent, cash is going out. So cash account you are going to credit. So your entry will be rent account data to cash account. There is a entry. See, rent account data to cash account. Being rent paid, amount is 3000. Okay. Now observe. Next transaction, paid salary to staff. What you have paid? You have paid salary. You means you the business. Business has paid salary. So salary, what is it to the business? It is an expense. So that expense account should be affected. So the account effect will be salary account. Then salary, how you have paid? Salary, how you will pay? In terms of cash only you will pay. So cash is going out of the concern. So other account affected here is cash account. So these are the two accounts affected. One is salary account and other one is the cash account. See, salary account being an expense to you, it is a nominal account. Since it is a nominal account, according to the rule of nominal account, debit all expenses and losses. Since it is an expense, we are going to debit salary account. Then again, cash account, if you observe, it is a asset, real account. Debit what comes in, credit what goes out. When you are paying salary, cash is going out. So this account you are going to credit it. So your entry should be salary account data to cash account. Observe here, salary account data to cash account. Being salary is paid. That is the entry. Okay. Next. See, on 10th date, purchased goods from RAM 40,000. What you have purchased? Goods you have purchased. From whom you have purchased? From RAM. Okay. Now here, when in case of purchase or sales, you should observe which transaction it is, cash transaction or a credit transaction. When you have purchased on from RAM, when he said, it means that you have purchased from RAM, okay, on credit. So when you have purchased on credit there, since you have purchased goods, one account effect will be ultimately purchase account. Another one is RAM account because this is a credit purchase. So RAM's account, personal account will come here, RAM's account. Observe, personal account is by nature it is a expense to the business there. Since it is an expense, it is a nominal account. According to nominal account, debit all expenses and losses. Here you have incurred this particular expense, as such we should debit this particular one purchase account. Then RAM account, RAM is a name of a person. So since it is a personal account, debit the receiver, credit the giver. When you have purchased, RAM is giving. So RAM account you are going to credit it here. So your entry will be purchase account data to RAM account. See, purchase account data to RAM's account. Being goods purchased. Right? So this is completed. Next one. On 11th date, purchase goods for 20,000. You have purchased goods for 20,000 means here you have purchased by paying cash because the name of the part is not given. It is a cash purchase. So the accounts affected are, one is purchase account, another one is cash account. See, purchase account, now only you have discussed it is an expense. It is a nominal account, so we should debit all expenses and losses. So purchase account you are going to debit. Whereas cash account is a asset account, it is a real account. Debit what comes in, credit what goes out. When you have purchased, cash is going out. So cash account you are going to credit here. So your entry will be purchase account data to cash account. Purchase account data to cash account. Right? I am making it very much simple to you people. Okay? Please go through this particular video more than once so that you will be able to get acquainted with the simple transactions there. This particular explanation, I think that you people are able to understand me. So please do share my video with your friends, relatives, with other guys there.
Okay, and subscribe to my channel and give me the motivation so that I can give you much more classes there. Please like, share and subscribe.